impact of 1.5 lakhs per annum. Your interest is an outgo, you can deduct that as an expense.
And also, bring your family into this. If your husband has only invested in real estate, I think the answer lies in front of you. Maybe you need to diversify. For example, my husband, it's divided. He does the real estate investment and I do financial assets. So figure it out, speak to people, find out what your requirement really is, I guess. Ritu, you wanted to add something?
All I was saying was that financial assets are definitely more easy to handle. So if you get a good price for the real estate, and as everybody has agreed here that real estate is not something which is likely to give you a great return in the next 1 or 2 years, then it might be a good idea to actually devolve and look at financial assets as a form of investment.
Yes, ma'am, here, you're next. Okay, so we're not going to take individual mutual fund queries. You can speak offline with our panelists and they can perhaps, throw more light on these individual products. What we're trying to do is, it's a classroom for mutual funds, so we will try and clarify the concepts first. Sure, you can take up all your individual mutual fund queries about specific products offline. She's been waiting for a really long time.
My name is Harshita Kaur, and what one figures out from this discussion today is that you need a certified, experienced investment planner for you. Now, how does one find about such a person and the person who can grow? Say, if I've never invested into mutual fund and I want to do it slowly, so how does one know about it?
You want to take that? Where do you read? Is there one website where all of us can go, compare all of them like a car dekho, compare the car prices, find out who's done the best?
There is no financial planner dekho.com.
No. Okay, that's a business idea then.
So that's a business idea. There's no financial planner.com dekho idea. But having said that, I think, like I had mentioned earlier, what you need to really look at is who you can connect with. And, that might take a couple of meetings. But like I was mentioning to the lady earlier, that women go by gut, and I really do think that is exceedingly important. I think also what is important is that what you may want to look at is vintage in the industry, because vintage in the industry helps the financial planner. Like all of the financial planner is pretty much one of a financial planner like everybody sitting here on the panel is pretty much somebody who chose to do something that you were not doing, and we chose to do this. And just like in your own industry, with years you've gotten a certain experience. So financial planners also with years get certain amount of experience, and I think that's something that you should consider.
Were we able to answer your question? Okay, so she can reach after the.
I think insurance advisors.
All financial planners.
We can help you with that.
I think insurance advisors can help us.
The easiest is wherever you're banking with, because each bank manager will be, they have those wealth managers associated with each account. So, the bank manager would be the first one. The first point of contact.
All the calls you've been ignoring up until now, would do the same their calls next time.
I think even the...
If one loses money in that, then one is really demotivated to invest into the next one.
I think the key is patience,
step at a time.
Yeah, and I think the key is patience. When you buy a property, you don't sell it tomorrow or day after, right? You buy it, forget about it for 20, 25 years. It's unfortunate or maybe fortunate in both the cases that there is so much knowledge and information out there on Androids, TVs, newspapers. You can literally track your financial investments on a daily or a second-by-second basis. But yeah, I think the key is patience in that.
Also, here's how I would do it, okay? It's more of a practical solution, but if I'm really lost and I don't know who to trust, this is what I would do. Look out for a financial advisor, and this by no means is a sales pitch. Who owns the company, who is an independent person, that person cannot run away, okay? And they are very conscious about where their brand. At least I am. I wouldn't do anything that would hurt my brand, right? So you might want to interact with somebody with whom the buck stops, okay? Secondly, there are financial planners who charge you, okay? Instead of charging, instead of getting a fee from the mutual fund, okay? That is more in your control. So they are then motivated to perform for you. So look out for those financial plans.
And what about the insurance advisors? Don't you think even they are, they have that kind of a tie-up with some wealth managers. I think we most of us have got the insurance. I'm here.
Okay, insurance is another key thing that Rita, why don't you highlight insurance? And again, insurance is there are a lot of aspects to insurance.
Yes, and I think
is there anything in particular that you're looking for?
No, what I felt was one could be comfortable with the insurance advisors who are further giving us how to invest money into liquid assets and liquid mutual funds. I think 25 years.
25 years?
Yeah.
Are you happy with the returns and the suggestions?
Yes.
Okay, then you've answered
So
your
I was just,
question.
I just felt like we could be more comfortable if we could speak to our insurance advisors. They further, they're actually expanding their portfolios.
Can I just disagree? There? Not necessarily your insurance advisor would be a good mutual fund advisor because they are two different industries completely. This is really the same thing as many years ago. It was always the chartered accountant that everybody ran to when there was anything to do with money. So the chartered accountant is really very good at his taxation, but he may not be the best as far as mutual fund investing and advisors. So the financial planners who belong to this particular space, and I think that would be a better bet for you than looking at an insurance advisor simply because you've been with that insurance advisor for long. Surely you should go with an insurance advisor if the insurance advisor is equipped with this industry, because they're two different industries.
So
In
go
my
with the
personal opinion, you should keep your insurance separate and investment separate. There you clearly know it. They are more transparent products when you do pure products. When you are trying to invest through an insurance product, you lose the transparency somewhere because you don't know how much are you charged, what is actually going into investments, how much is going towards your mortality rate paying the premium. So you do not really know. It is not very clear. So if you just have a pure insurance requirement like a life cover, then you can approach your investment advisor. And actually, financial advisors like us offer both kind of services. It is like a complete plan. So both the risk is covered through insurance and investments are done through the mutual fund route or their various avenues to do it.
Okay, now, yes, you have a question.
First of all, thanks very much for giving us such great information. So basically my question is with regard to insurance only. So I was wanting to know that insurance, besides providing a good life cover, so is it a good investment plan also for future, like we were discussing about, say, investing for kids education. So something, if you're looking 10 years down the line, so does insurance provide a good investment opportunity also?
Now, Rajat, that's another core area that we were talking about, your child's education or your grandchild's education that you want to, gift him. It's not always a car or a house. Why don't you give him a corpus for his future education? So, how should women go about that then?
The thing is, there is no wrong or right answer. You could either make an investment plan for this bucket, for this requirement, and it could be a mix of, various asset classes. So if the lead time is 10 years, you could still do a mix of equity funds and debt funds through the mutual fund route, and a financial advisor can guide you towards it. But here the important thing would be that this is a bucket where the requirement is 10 years from now. So you need to continuously invest into it, build this corpus, maybe closer to the 10th year, maybe 2-3 years prior to that, you start reducing your equity exposure there. But you need to be disciplined about it, that this money you are not going to touch for anything else. That tomorrow suddenly you are tempted to buy another flat somewhere for investment, you are not supposed to dip into this. So as long as you feel you could be disciplined about it, this is a better avenue, it's more flexible. Whereas in terms of insurance offering, where they say a child care plan, it is more of a packaged product. They market it like that. Underlying still remains the same. They will still do a mix of debt funds, mutual funds, and give you a life cover. So it's just a question of packaging. And in insurance, the good part is that there typically people are more disciplined. Like you have to pay a premium. So you will go out and pay your premium every month, every year, and so on. But usually in mutual funds, people are not able to be so disciplined. That is why I feel insurance products have been more successful in capturing your attention. But I would go the first route, personally.
The lady at the back in the green dress.
It's on. I just need to clarify. clarification on the same issue which is in discussion. If I want to go with both mutual funds and insurance, what advice would you give? What should be the proportion? If I am looking at investing in mutual funds, short term and long term, as well as insurance, which gives benefits post a certain investment period, would there be a 50 or 60-40 investment advice?
Okay, you will hate me for this, but ballpark, what is your age? Because then we can get a better sense.
I'm 30, so.
Okay, great. So Rita, why don't you take this one? Okay.
Insurance and investments are two completely different things. So, it's very difficult to say that this X percentage should go into insurance and X percentage should go into investments. Insurance is not really an investment vehicle. Insurance is a protection vehicle. So, only as much should go into insurance, as much as protection that you need in terms of what you want to leave behind just in case there is something that happens to you. For investments, purely because of the flexibility that it offers, that mutual funds offer, you should look at an insurance product for the protection need, and you should look at mutual fund products for investment needs.
I totally agree with Ritu. And insurance is an insurance, and that's where the full stop is. It's protection. Okay. Let me make it really simple for you. They invest in debt funds, they invest in debt funds. They invest in equity, they invest in equity. Right? Insurance cuts mortality. That means a small amount is deducted, small or big amount is deducted for protecting your life, that amount. This one doesn't detect. Which one will perform better? So an investment vehicle is mutual funds, protection vehicle is insurance.
So don't you think insurance covers your risk as well?
1 second, just wait for the mic to reach.
Risk cover.
There has to be a little balance, I think.
Yeah, it has to be risk cover and protection.
So yes, there has to be, which is why you should do insurance to the extent that you want that risk cover. And you should do investment for the growth of your portfolio, you should do the investment. For the risk cover, most definitely you should do the investment.
I want to know what is the correction and what impact does it have on the mutual fund that we have invested?
Correction in NAV value.
A correction is really a change in the valuation in the market, whether it's stock market or bonds, where the values have gone down. Like you would probably hear Aisha every day in terms of something being up and something being down. The stock price being down is the correction that we talk about. So,
if you have invested in some mutual fund and then they say, oh, there has been a correction, so then you've lost a certain amount of money. So how do you understand that?
see, mutual funds are the vehicle where you invest, and the mutual fund invests into the stock market. So if there is the broad market index that has gone down, then your mutual fund investment will also go down.
That is the risk that you're taking when you invest.
That's the risk you're taking when you're investing.
Since you're investing from a long-term perspective in an equity mutual fund, so in most cases, we would advise you to ride out this volatility. I mean, somebody would have warned you in the beginning that this is going to be a volatile journey. It is not going to be a one-way up throughout your 5 or 10 year period. So during this bouts of volatility, maybe use it to your advantage. During periods of correction, maybe you may want to add to this asset class.
And one can't predict when the next...
I don't think anybody can predict
over
that.
over a long term, it evens out. And that's what one is talking about when one is talking about riding the wave and sitting through it with the correction. Because over a long term period of time, it evens out. If you see any rolling 5-year periods, there is statistics which shows that there is a positive return and a reasonably good positive return.
Excuse me, I was never interested in mutual fund, but I got interested now. But what you're saying,
Okay, I think we shall clap
yes,
on that.
everybody's been telling me to invest, and I said no. Okay, but you young ladies,
reasons for saying no.
it's lovely to talk to you. And